In this week's update, the market message flipped strongly on its head. Are you gambling on AI with the herd, or are you selecting via a process? And commodities spring back to life, abrupt change in character for gold. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. What a tumultuous week it was, and we've really flipped over from one theme to another. And the message from the market is unambiguously strong. So it's a very positive video this week. Let's get stuck straight into it. The US indices set new all-time highs, except the NASDAQ, but certainly the S&P and the Russell did. If you step back and just look at the year to date, we've had 7 months in, and the market's had absolutely everything thrown at it. Wars, tariffs, inflation, all sorts of fears, rational and irrational, about AI. But the bad news has failed to break the trend. And of course, the bears would immediately jump on their soapbox and say, well, look how expensive it is. All that's happened is that the multiples have gone up. But that is not the case at all, because the corrections that we've had along the way, the market has absorbed, and absorbed relatively easily. The buyers just keep coming back at higher and higher levels. And you've got to step back and ask yourself why that is. Are there that many dumb people in the world that they want to keep paying more and more for the shares they buy? Okay, there are a lot of dumb investors in the world, but the money flows are sending a very, very strong message. And also, it's broadening. The market breadth continues to improve. And we've had 336 of the S&P 500 have gained so far year to date. So this is not just about the Mag 7, it's not just about PE multiple expansion. This is about good old earnings. So the market reality is that all major trends need resets from time to time. We saw it in the gold market in 2025, very powerful run. We've seen it over the last couple of years, albeit with a couple of little corrections in the AI trade. But every trend is built on the emotions of fear and greed. And inevitably, they have to run to excess. And so the AI trade ran to excess, and then it just needs some sort of catalyst, and it reverses, and then psychology goes in the opposite direction. And when we get to the Australian market, it's very interesting to see the investor sentiment is pretty much about as far as it goes, unless there's a real market dislocation. So we're now at something close to peak bearishness. So what a beautiful time for a reversal of some of the trends that we've seen, particularly in commodities. Now, those resets rarely happen fast and happen quickly. So the AI reset may not be finished yet. It may, but it may not. So that becomes a matter of how do you participate? It's not an do you or don't you, it's a how to at this stage. Now, during the correction that we've seen in parts of the AI trade, most investors were forced into going with some of those rotations because their psychology gives them no choice. They can't withstand the sort of volatility, 15, 20% in a day in individual stocks. Most investors can't withstand that sort of volatility. But the key here is understanding who you are and sticking to a consistent process that makes it easier for you. That's really the key, not trying to do something that your psychology just will not allow you to do. So we're down to the earnings. That's always going to underpin the market, and it's the real answer, and the earnings estimates have been as strong as ever in this season. We've got an 86% beat rate, which is right up there. We've got a very strong earnings backdrop in America. 10 of the 11 sectors are reporting earnings growth, and 11 of 11 sectors are reporting revenue growth. That's a stunning indictment of where the market is sitting at the moment. Now, as I said, a lot of people will immediately jump up and say, yeah, but what about the valuations? They've gone up, and so that's all that's happening here. And granted, the valuation levels are not cheap, but the key thing is, what are the earnings growth doing? And the earnings are growing faster than the prices. So that means that the forward PEs are coming down, and that is far more important. And money flows are confirming. Not only are the fundamentals pointing to the upside, but the money flows are certainly confirming it. So the conclusions to draw from the 7 months year to date, the bullish case is even stronger than it was at the end of June. So that's a positive. The AI trade in all its forms, and there's about 5 different layers to it, has reset, but not necessarily the entire AI stack. And it hasn't broken, and there's been no serious damage done. Earnings are accelerating, and in some cases the earnings growth is just absolutely stunning, more than 100% year on year with a lot of US stocks. So the reality is that there will be corrections, and there'll probably be 1 or 2 more before year end. They might only be 10% variety, but at the individual stock level, they can be pretty nasty. As I said, 10, 15, 20, even more % move in a single day is becoming common. The market is rewarding stocks that are doing well, but it's penalising stocks, even many stocks that are beating estimates, but they're just not beating them enough. And they are getting absolutely slammed. The market response is brutal if the stock is not delivering what the market was expecting. But look, through all that volatility, and it makes it more difficult, but shouldn't be a turn-off for investors. You've got to see them as opportunities that you position yourself for. And that means that you need some cash in advance to take advantage of that. So you exit your weaker positions, your weaker fundamentally and technically positioned stocks, and you get set for the next phase. Now, you still require good thought about weightings, about your discipline, and about your exit rules. This is not a change of character that's just going to float all boats. It's becoming very, very evident that the market is treating stocks very much on their merits. Now, during the year, there's been several periods where there were no shortage of reasons to sell. If you go back to previous slide, the wars and the inflation and everything else, and no shortage of reasons. You could have found it easily. But what we did lack was the sustained evidence that you should actually do it. And that has really been missing all year. So that's the assessment of where we've come to so far in 2026. But through it all, you need to be organised. I think that's the consistent message that I've put across all year, in fact, all decade, is that you need to be organised in advance with all of the advice that you need. Let's look at American stocks now. The S&P added a very healthy 3.6, but the NASDAQ sprang back by 5.2. And also the Russell, up to new highs, was up 3.5%. The narrative last week was pretty sombre at best, but now it's positive and powerful right into the end of the week. The July non-farm payrolls missed by a long way. They were actually negative compared to an expectation of about 80,000. So that was certainly unexpected, and that really jolted markets out of this mindset that the next move by the Fed had to be up a rate hike. So the odds of a rate hike have now plummeted to below 50%. The US dollar index has dropped down just under 100. So that's been a change. It was only a week or two ago we were knocking on the door of 101.5. So it's been, at this point in time, a false breakout in the US dollar. The 10-year yield actually came back off for the peak at 4.65. Hit a peak around 4.7, I believe. And the VIX also came off further, and it's now down under 15, which is almost getting down into complacency territory, if you can believe that. So let's go and look at some charts. We'll start with the NASDAQ, and this is on a weekly chart. That's a pretty emphatic change of character. And it's pretty much where you would have expected it to occur. If we put that back on a daily, this is pretty much the level that you would have expected to bounce. We overran it for a couple of days, but that's okay. And now we've bounced back very strongly. And just looking at a couple of the stocks, that's Microsoft. These are weekly charts as well. So there's an emphatic move. Microsoft And the software sector had been struggling for some time, since around about October-ish last year. And there's Amazon, which also had a significant breakout, pulled back a little towards the end of the week. So it's just a retest of the breakout, which is perfectly normal. And this is NVIDIA on a weekly chart. So NVIDIA was kind of getting lost in the enthusiasm for a lot of other AI stocks, but it had a pretty solid week as well. But the absence of volume, I think the one thing that I did observe around the US market last week was, by and large, the absence of significant volume. So that tells you that there is probably a degree of short covering that has fueled this. So that's why I'm not all in, boots and all, in the AI part of the market at the moment, because it's good, don't get me wrong, but it's just not quite as robust as I thought it could have been. So there could be other factors there. Consumer discretionary versus consumer staples had a breakdown last week, but rebounded very strongly. Semiconductors on a weekly chart also managed to find some ground. But again, that's a lower than average volume for the week. If we look at the relative comparisons, healthcare continues to lead the pack. Finance had done really well, but certainly backed off the last couple of weeks as the market went more aggressive. And then we've got XLK just storming back from down the bottom. So there's been quite a shift in the sector rotations within America. The S&P on a daily chart, let's just pop that on a weekly, and you can see that is also a pretty emphatic breakout after a very tight coiling. And IWM, again on a weekly chart, broke out and set new all-time closing highs. So it's all very positive in America at the big picture level. And if we look at the currency, there's the US dollar on a daily, but to get a wider view of that, we had 2 big weeks down. So is this just a false breakout? We'll find out shortly. And the Aussie dollar, of course, heading in the opposite direction. So that's the US market. Heading now to the Australian market, our dollar finished just on 70. Index was up 3.2% for the week, so good at the index level. But as I say, pretty much every week, it doesn't really tell you very much. We've had a significant reversal in leadership, which is what you'd expect, and our market being heavier on the commodity side, we could be in for a pretty good period. And it's really telling that this has all happened right when the investor survey of bullishness and bearishness was hitting something close to 50 on bearishness, and the bullishness had dropped to the low to mid-20s. It's no accident that that happens. Fear takes over. Investors' sentiment just gets worse and worse and worse. That flushes out most of the sellers, and then the market really has only one way to go. So, very interesting setup in the Australian market, but certainly you've probably got to expect that the odds will favour the materials side of the market for at least a period. So the validation doesn't get much stronger when the sentiment is at such a low level. And we've also got some of the real market leaders, some of the top 10 and 20 stocks in terms of market cap that are really, really high quality, big picture stocks, the sort of stocks that you could own for the next decade, and they're trading at historically low valuations. So there's certainly some opportunity in Australia, and it doesn't have to be resources, but I think there is a very powerful opportunity in resources. Precious metals, gold explodes, the only word I can use, higher to 43.40. So we've broken out of that very tight range that we're in between 3,900 and 4,100. Silver also rebounded quite nicely, was up about 10% for the week. And I said last week, the explosive move in gold is coming soon because of both the fundamentals and the technicals, which we'll look at in a minute. And it's really instructive to see that the miners moved harder than the underlying metals. That's always a great sign. And when we look at the gold stocks, last week I said the downward momentum was stalling, and that's generally the precursor to a reversal upwards, but the reversal was explosive, seriously explosive. So that was very good confirmation. Let's look at those charts. So we'll start with the gold stocks while we're here. This is GDX in the US. So this is on a daily chart. So you can see some significant gaps basically from the start of the week. Gap, and then another gap, and then another gap to finish the week. So if we put that on a weekly, it really was a very significant move. That's what it looked like. And that's as emphatic a reversal as you've seen in gold miners for quite some time. In the Australian market, we had a base formation. It was lacking confirmation last week. Well, we got that confirmation on Wednesday. And whilst there were plenty of people who wanted a position early, there was absolutely no guarantee at all that the next move here was up. It should have been, but this could have easily broken down. So waiting for confirmation is far better than trying to guess it, because the next bull market, the leg will be the second leg up, the initial first leg higher, and then the second leg, once it's consolidated, is generally the strongest of them all. So this is destined, not guaranteed, but destined to go quite some distance. So who cares if you miss the first few days? Isn't it better to have greater odds in your favour? I mean, that's the way I look at it. I don't mind paying 10 instead of 8 if my odds of success are 10 times higher, if you understand what I mean. This is GDXJ, so the juniors, but they're all pretty big in this group. And that was also an absolutely smashing turnaround. Big gaps left, right and centre. All right, let's just go and look at gold and silver now. We'll look at silver first of all. So there's silver on a weekly and it's stabilised and bounced. Look at that, pretty much right where you'd expect it to. So that's a very nice technical setup in silver. It went way deeper than I expected, than a lot of people expected. But that's what you've got to do with the market. You've got to allow for the fact that the market will do things that you don't expect. This is the gold chart on a daily. This is what I had last week. The most potent contrarian trade in 50 years is coming. And it will resolve with force. Did it what? This was where we were sitting last week, just in here, in this rapidly closing triangle, and we just exploded out of there. If we put this on weekly, you'll see it even more clearly. So that is a pretty significant move in gold and silver. And finally, on precious metals, this is the chart that I've been looking at, the ratio between gold and the S&P index. And we've now stabilised in the base and we've now pushed higher. The weight of evidence, the weight of validation is looking pretty strong. Just be aware, though, that often, particularly when the sell-off has been brutal, as this one was, that we often don't just get a straight V-shaped recovery. The last 3 days of last week were pretty amazing, so we may well get a V-shape, but it's not a given. We may go down again and form a kind of a W formation. So we go explosive move out, bit of consolidation, bit of a rethink. The weak hands, the losers who are looking to reduce their exposure, sell into that first bounce. So just be aware of that. Other commodities, copper, 657, got up to about 672 at one stage, so that was very solid. Crude oil has been all over the place. And of course, driving it is the erratic decision-making of President Trump. So I couldn't feel any degree of confidence in that whatsoever. There's the copper chart. So you can see we got up to about 6.73, 6.72. And there's the crude oil chart as well, a bit of a bounce towards the end of the week. So wrapping it all up, absolutely no trend is ever guaranteed. But the last few days really does look like a very powerful change of character for the market as a whole, for numerous sectors. AI is still alive and well. There are far more parts of it now that are looking extremely positive, both fundamentally and technically. what is hard to determine is how the market is going to treat seemingly really good earnings results. That's the trick at the moment. Company can come in and comfortably beat revenue and earnings forecasts and be down 20% on the day. So that's the volatility wildcard at the moment, but that doesn't mean that the opportunity for much higher prices over the next 3, 6, 12 months is certainly not there. Volatility is going to remain, so that means forward thought, forward planning. It's not hard, just takes a few minutes as long as you zeroed in on the things that are important. So that's it for this week. There'll be no Sunday video next week, but we'll be back with you the week after that. And I'm sure after 2 weeks of this kind of market, there'll be plenty to report. So enjoy your weekend, and I'll see you in a couple of weeks. Cheers.